So welcome back guys, and if you're looking to double your money in 25 days or less, probably there is only one way you can do it.
जोर जोर से बोल के लोगों को स्कीमें बता दे।
We all know there's no way, but if you really want to start investing in a systematic manner and want to grow your money over time, then you are at the right place. Even if you are a student and you can save at least 500 to 1000 rupees per month, then that is sufficient enough to start investing. So watch this video till the end to know about the different investment options for you to start investing. In this video, we will talk about the factors that you should always consider before choosing any investment. What can be the top investment options for you to start with, and a pro tip at the end of the video which you should always remember about personal finance. So let's start. There are three major factors that you should always consider before finalizing any investment. The first one is risk, and it is defined as the chance that your investment's actual gains will differ from the expected returns. It also includes the possibility that you might actually lose all of your original investments. Next factor is liquidity, which refers to the ease with which an asset or an investment can be converted into ready cash without affecting the market price. And the third factor is the return, which is simply the money you make or lose on an investment over a period of time. Before we start discussing the different investment options for you and which one would be the most suitable, let's talk about the rule of 72 in finance, which is a useful formula used to estimate the number of years required for your investment to be doubled. It is just a simple calculation of 72 divided by the interest rate that you are expecting on your investment. So for example, you invested rupees 10,000 and you are expecting a rate of 9% return every year. So your investment would approximately take 8 years to double itself. Naturally, higher the rate of interest, lower would be the time taken to double the investment. The first is not even an investment option, but still the most popular method to save money in the form of real cash. While the risk of keeping cash under your mattress or in your pocket is really low, it is still not zero, because we have seen things like demonetization. Now the liquidity of keeping money in form of cash is really high because you can use it right away to buy anything you want. And the returns on keeping money in the form of cash are negative. Yes, because while you keep your cash, it doesn't grow itself, and the inflation will still happen, and the purchasing power of your money in the form of cash will keep decreasing over time. Now with that, let's discuss the real investment options for you. And the first one is savings account. It's just an account you open with the bank to deposit and withdraw money, and it is almost like keeping cash but with the bank. The risk associated to keeping cash at bank in a savings account is very low but still not zero, and the liquidity would still be very high because you can walk to the bank and get your money withdrawn anytime you want. And the returns would range from low to negative in a savings bank account because it largely depends on the bank that you are choosing and the inflation rate for that year. An average estimate on what you would get in a savings bank account would be largely around 3 to 4% per annum. Another low risk option can be a fixed deposit with the bank. Now it is just a financial instrument provided by banks and NBFCs which provides you with a higher rate of interest than a regular savings account until the given maturity date. While the risk of keeping money in an FD is low, the liquidity is also low because it depends on the time that you are putting your money for, and you can't withdraw your money before the given maturity date if you don't want to pay penalties. The returns on FD ranges from 4 to 7%, and it depends on the time period you invest for and the bank that you are choosing to invest in. And the next investment option is something which our parents and grandparents have been doing all their lives. That is investing in gold. While the risk on investing in golds is medium because the prices of gold keep fluctuating every day, the liquidity is also medium because every time you go and sell the physical gold or the gold bonds that you buy, there should be a buyer in the market as well. And the returns on gold have actually been more than the returns from Sensex in the stock market for the last 2 years. And they also keep fluctuating year by year. And considering the returns for the last 10 years from gold, you can expect somewhere around 10 to 15% return, because the range is somewhere from -5 to almost 32% returns in 2011. The next investment option, and the most interesting one, is the stock market. Stock market is simply a market where you can buy and sell shares of any publicly listed company. In India, the companies are listed on either Bombay Stock Exchange, that is the BSE, or the National Stock Exchange, NSE. But remember, you would be solely responsible for tracking the shares that you want to buy them and then sell them. If the company does well that you are betting your shares on, you can actually gain a lot of returns. But if you choose to invest in a company that doesn't do well in future, you actually might lose all your investments. For example, Yes Bank, which has seen a journey from rupees 400 per share to rupees 10 per share. So the risk associated with stock market is usually high. And the liquidity in stock market is medium, because the settlement period in a stock market is T+2. That is, you will get your money at least 2 days after you sell the shares. Now the returns on stock market are usually medium to high, depending on the share that you are choosing to invest in and the time frame that you are choosing to invest. If you find it difficult to understand how a mutual fund works, consider this as a team activity or a project that you do in your office or college as compared to an individual presentation. Don't you feel safer with the team? A mutual fund collects money from all of us and creates a pool of that money. A mutual fund manager then decides to invest that money in bonds, stock markets, or bank deposits. All you have to do as an investor is to invest the money and keep tracking the returns on that mutual funds on a yearly basis. You can invest in a mutual fund as a one-time investment or as a systematic investment plan, where all you have to do is keep investing the same amount on a recurring basis. There are a lot of mutual funds, and it totally depends on your time horizon and the money you want to invest in for the best mutual funds you need to select. Now we all know about the risks in mutual funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
And yes, that's true. Mutual funds are actually subject to market risk. The liquidity in mutual funds is also medium, because it would usually take you 1 to 3 days to get back the money that you withdraw from the mutual funds. And the returns on mutual funds range somewhere between 7 to 15%, depending on the mutual fund that you choose to invest in. Some mutual funds are good for short-term investments, while some are good for the medium to longer-term investments. You could also invest in mutual funds for tax savings. Those are called the ELSS mutual funds, which is the equity linked saving schemes. And a tip at the end of the video would be that every rupee saved today is probably more than a rupee earned tomorrow, because every long journey starts with a small step. So if you haven't, please start investing right now, because this is a great time to start investing. You can start by taxing yourself 10 to 15% of your monthly income and start investing in. Thank you so much for watching the video. And if you liked the video, please hit the like button, share the right information with your friends and family, and subscribe to our channel. Stay safe. Stay invested.